Hi, everyone. Hello out there. I am Leslie Chapman, and I want to welcome you back to the Your Harris County live show. For those of you who are new to joining us, Your Harris County is the coolest tribe of Cypress and Northwest Houston residents who keep up with the latest trends in the area, local hotspots, restaurants, outdoor and lifestyle activities, and real estate. In today's show, we are continuing our discussion on multifamily syndication. Last week, if you recall, I discussed the benefits of multifamily syndication, and today we are talking about how multifamily syndication deals are structured. So, first off, let me say it's a lot of information, so you're probably going to need to repeat this again. Save it, download it, or what have you. But it's a lot of good information, value for those who are providing value for those of you who are especially interested in this form of passive investing when it comes to real estate. Okay, so just telling you up front, bear with me, a lot of information, but it's good stuff. All right, so there are a variety of ways to structure multifamily syndication deals. Today, I'm just covering the basic components of it. So there are going to be nuances because they're, depending on each deal, a business plan can be set up and what is stated in the business plan is it's going to vary from asset to asset. But the components pretty much stay the same. So that's what we're going to focus on, the high level. First up, let's talk about key terms that are involved in multifamily syndication deals. Some of this you have heard before from my previous videos on passive investing, in particular when I was talking about syndication structures. But I just figure it's best to kind of review some of those terms because you'll hear it used a lot in what I'm going to share today. You have the sponsor, the general partner, and operator. Those words are used interchangeably. They're referring to the same person or people who perform those functions in the deal. So sponsor, general partner, operator. The sponsor finds the deal and is accountable for managing the operations of the asset. You also have the passive investors who are the limited partners in the deal. And if you remember, passive investors, they take more of a passive role. They're not as active as the general partner, okay, who's the sponsor. Then there is the entity, and this refers to which structure the deal will be set up under. The most common type of structure is an LLC. And some LLCs, the way they're set up for multifamily syndication deals is they have classes of membership. For example, a sponsor could structure a deal where the Class A members are the passive investors and the Class B members are the sponsors. The Class B members would be responsible for the signing of the loans and managing the property management company or any management of the asset on behalf of the Class A investors. Next, there's something called equity split. This term refers to how the cash flow and sale proceeds will be dispersed between the limited partners and the general partners. Typically, the equity splits for these types of deals are either 70-30 or 80-20. So we're going to step through an example. In a 70-30 equity split, the limited partners or the passive investors would receive 70% of the cash flow, and the general partner, the sponsor, receives 30% of the cash flow. Syndication deals could also have other types of equity splits like 50-50, but this all depends on, the particular deal. So there may be some variations, but generally the splits are either 70-30 or 80-20. It is also common for multifamily syndication deals to offer investors preferred returns. A preferred return is a certain minimum of cash flow that is paid out to the investors before the sponsor is paid. Now, let's look at an example, and I'm going to use some numbers. So this is part of where I'm saying you might want to review this video so that you can get a better understanding. So let's say there is a multifamily syndication deal that you're participating in or a sponsor has found, and it has a 70-30 split. We've already addressed what the 70% means. That 70% goes out to the the passive investors and 30% goes out to the general partners. In this example, the passive investors put up a total cash investment of $200,000 and the preferred return is 5%. So this means that the first 5% of the $200,000 is going to be paid out to the passive investors. And then whatever is left over is going to be split 70-30 between the limited partners and the sponsor. A preferred return in this deal, if this deal, for example, generates $20,000 in total cash flow for a given year, then the passive investors would receive 5% of that $20,000, which is $10,000. And then the remaining $10,000 would be split 70-30 with the sponsor. So and of that remaining $10,000, the passive investors would receive 70% of that, which is $7,000, and the sponsor would receive 30%, which equates to $3,000. So I know it's a lot of numbers. I actually, have a blog where this will actually be written out, which will make more sense. But, because it's easier to see the text, but you kind of get the gist of it. Now, so in this deal, ultimately, the limited partners end up getting $10,000 plus $7,000, which is $17,000. Now, if the deal did not have a preferred return, the entire $20,000 cash flow would be split 70-30. So 70% of the $20,000, $14,000 would go to the passive investors, and 30% of the $20,000, which is $6,000, would go to the sponsor. You can see in the second deal, without preferred return, the passive investors actually come away with less. And so preferred returns benefit the passive investors more, and they're a good incentive to attract them, but not only attract them, but keep them in the deal, keep them vested, because then if they have a preferred return, and they're going to be more, engaged in what's going on and, with the deal to make sure that the operator is managing properly so that they can get a return. So I hope that makes sense. Next, I want to address who has control in a multifamily syndication structure. As stated earlier, the LLC contains limited partners and general partners. And if you recall from a previous video, limited partners have limited responsibility and obligations in this structure. Their financial and legal liabilities are limited. The only thing or only risk, which is it's an important risk, but the only risk they really have is losing the money that they have invested. But that's it. Nothing else can be touched. The general partners, however, bear more of a burden, and because they play an active role in the syndication. They manage the day-to-day operations. They sign documents. They decide when to sell or refinance the asset, and they're also responsible for dispersing funds to the passive investors. When it comes to voting, typically voters will vote their shares, but the more capital that they put into the deal, the more weight that their vote carries. So as an investor, I want to switch gears now. You may also be wondering, how long is your money tied up in multifamily syndication deals? And it does depend, but typical syndication investments, your money can be tied up sometimes between 3 years. Now it's looking more like 5 years, 7 years, 10 years. It really does depend. Now, typical syndication investment amount starts at $50,000. There are some that start at $25,000, but you can see that with those types of monies that we're talking about, and it's $50,000 or more, you want to make sure you know what the time frame is for getting your money out, and you also want to know what methods are going to be used to getting your money out. And there are typically two ways that you can get your money out, and that cash can you can get your money back by a cash out refinance or via an actual sale of the asset. So cash out refi refers to okay, so cash out refinance. Hey, whoever's out there, thank y'all for watching. But the cash out refi refers to the property being under your control for a period of time. Hi, Miss Judy. And adding value to the property. And there are a number of ways you can add value to a property. So you increase the property value. I I won't get into those details of what you can do there, but the properties, when you increase the value, the property appreciates. And after a specific period of time, hey, Asha, after a specific period of time, the sponsors could choose to refinance the property and pull the equity out and disperse it to investors. That's called paying the investors back their initial investment. So that's what a cash out refinance is. You hold you have a property under control, you hold it for a period of time specified by the lender, you add value, you do different methods to increase the value of the property, then you can refinance. You can pull that money out and you can pay off your investors either all or some of their initial investment. The other way that investors can get their money back is or recoup their original investment is through selling the asset. And that depends on the business plan. Because every business plan, hey, Asha has an exit strategy. And so the exit strategy may be to sell it after 5 years. And so what you'll need to do when you get into deals like this is make sure that the sponsor is clear through the business plan when they intend to sell, what their holding period is. This way you know how long the money will be tied up. So those are the two ways that investors can get their cash back once they put it into the deal. But understand, this is not a 1-year thing. It's at least a 3-year, mostly likely a 5-year or longer time that the money is going to be held in. But you will be getting cash flow on a monthly basis as the asset is operating. So also keep that in mind. That's a huge plus for multifamily syndication investing. Last, I want to discuss fees. And, fees, there are a number of fees that occur here. But after all, the sponsor fees are important because the sponsor is bearing the brunt of the workload in multifamily syndication deals. So there are 4 types of fees that you can typically see in multifamily syndications: acquisition fees, asset management fees, capital transaction fees, and disposition fees. So the acquisition fee is payable to the sponsor at closing. It's typically 1% to 3%. But I don't want to focus on like what the percentage is. I think what's important is what the fees are for. So the acquisition fee is paid to the sponsor for doing the work of finding the deal, tying it down, negotiating with the seller, raising capital, bringing on the passive investors, performing the due diligence, arranging the financing, putting up their own money, risking, their own capital into the deal, getting those team of vendors, the brokers, the property management company, all the other vendors that are going to be involved in controlling the asset and bringing all the group of investors together. So for that work, that's the acquisition fee. Hey, Donna, good to see you. The next fee is the asset management fee. Okay, so acquisition is to acquire the property. Now asset management is that you got it and now it's operating. So that asset management fee is used to compensate the sponsor for the time and overhead required to manage the investment on behalf of the passive investors. I mean, let's face it. Passive investors got into this so that somebody else can kind of do all that, right? They want to reap the benefits of it, but they didn't want to do all of the work. So that sponsor is accountable for that. And for that, they get a fee, which is typically 1% to 2% of the gross rents collected each month. And so, for the properties under management. So that's the asset management fee. Then there's the capital transaction fee. This fee is payable when there's a cash out refinance, which returns a portion of money of capital to the passive investors. And you can get to the cash out or this capital transaction fee if you've executed or if the sponsor has executed their business plan correctly or as best as possible and they added the value, the property appreciated, and now they can engage and they waited from the holding period, they can engage this transaction where they could pull the cash out. And for that, that's a 1% fee of the loan amount that goes to the sponsor because they're managing an asset correctly. So consider it like a reward for the work that they're doing there. And then finally, when the property is sold, there is a disposition fee. Now, this is paid at closing and is typically 1% of the sales price, but it also gives the sponsor incentive to continue to execute the business plan until the sale of the property, which means they've added value to achieve the highest possible sales price. And so for all those roles or functions that the sponsor plays, That's why those are the fees that are in there. So you may be thinking these fees are excessive. They may be a lot, but remember what the sponsor is doing. You know, this entity, this asset under management is an LLC. They are running the business on behalf of the passive investor. If that was your role here, they're running the investment on your behalf. So these fees help cover the expenses and the overhead of running your business. The real money that sponsors make comes from increasing the value, executing that business plan, increasing the value of the equity that they hold in each property. So there you have it. This is what I wanted to talk about today. I know it's a lot. And again, I said, you know, at the beginning, you may want to listen to it again because there are a lot of nuggets in here, but wanted to continue on our conversation about multifamily syndication and how deals are structured. If you'd like to learn more, I invite you to leave a comment below or send me a private message. You could get on a mailing list where we talk more about multifamily syndication and then actual deals that are available if you choose to participate in it. Also, I have a blog, yourharriscounty.com, and you know, you could check out the blog as well. This video will be on there as well as the text that supports this video, so you can actually read what it is that you know, read the words and then see the numbers on paper. Sometimes that's a lot easier to process than just listening to it. So that concludes today's Your Harris County Live, and I'll see you next week. And I also wanted to apologize that I didn't get on yesterday. I was out with clients, but so figured let's be consistent and let's just do it on the next day. But usually my Your Harris County Lives are on Tuesday, and I will resume next Tuesday. And one more plug. This platform may not like it, but I have a YouTube channel. So subscribe to my YouTube page and you get all these videos there. All right, take care. Bye.